Hey everyone, welcome back to Corporate Decoder, the place where we unravel the hidden stories in corporate filings. And today we are diving deep into Fulton Financial Corp. Oration's latest quarterly report, a document packed with numbers that tell a tale about where this financial institution stands and where it might be heading. Get ready, because we are about to decode the financial ins and outs of a major regional player that might just surprise you. And before we get started, if you love getting straight to the core of these massive SEC filings and understanding what they really mean for a company's future, be sure to hit that subscribe button and ring the notification bell. We also have a fantastic community growing over on our Discord server. Check the link in the conversation below to join the conversation. Alright, let's get straight into it with Fulton Financial Corporation, a company that operates in the financial services sector primarily through its banking subsidiary Fulton Bank. The report we are looking at is their quarterly filing for the 3 and 9 months that ended on the 30th of September of 2025. It gives us a snapshot of their financial health after the third quarter. First up, the balance sheet as of the 30th of September 2025 and the 31st of December 2024. Looking at the assets, total assets were around $31.995 billion at the end of September 2025, down just slightly from about $32.071 billion at the end of 24. That's a very stable picture. But let's see where the money is tied up. Investment securities available for sale, those are assets they can sell if needed, went from about $3.410 billion to $3.594 billion. That is a positive sign, showing an increase in their liquid investments. Net loans, a big chunk of their business, remained almost exactly steady at about $23.665 billion both for 2025 and 2024. That streetability in loans is interesting, especially considering how much the world has been changing. Now let's flip over to the liabilities side total. Liabilities saw a slight decrease from about $28.874 billion at the end of 2024 to $28.581 billion at the end of September 2025. Deposits, the lifeblood of any bank, saw an increase, going from $26.129 billion to $26.332 billion. That is good news, indicating customer confidence and a steady stream of funds. Now, borrowings, however, decreased significantly from $1.782 billion down to $1.471 billion. This suggests the company might be relying less on borrowed money, which can be a sign of strength or a strategic shift. Let's move on to the income statement for the 3 and 9 month periods. This is where we see how the company performed in terms of making money for the 3 months. Ended the 30th of September 2025, net income came in at $100.454 million. That is a substantial jump from $63.206 million in the same period last year. That is about a 50% increase, which is pretty solid for the longer 9 month period net income. Was $292.639 million, up from $220.122 million. The year before, that's a roughly 33% increase. What drove this income growth? Well, net interest income. That is the difference between what they earn on loans and investments and what they pay on deposits and borrowings. Increased significantly for the 3 month period. It rose from $258.009 million to $264.198 million, and for the 9 month period it jumped from $706.666 million to $770.305 million. That is a healthy growth in their core banking business. Interestingly though, the provision for credit losses, the money set aside for potential loan defaults, actually went down for the 3 month period. It dropped from $11.929 million to $10.245 million, and for the 9 month period it decreased from $54.910 million to $32.749 million. This could mean they see fewer risks in their loan portfolio, or perhaps a more optimistic outlook on the economy. Non-interest income, that is fees from services like wealth management and commercial banking, was about $70.407 million for the 3 month period, up from $59.673 million last year. The 9 month period saw non-interest income at $206.786 million, down slightly from $209.806 million the previous year. The gain on acquisition that's related to the Republic First Bank deal in April of 2024 was zero this year, but gave them a significant boost last year, showing how that acquisition impacted their short-term numbers. Now, let's look at expenses total. Interest expense actually decreased for the 3 month period from $226.089 million to $196.574 million. This is a notable decrease of about 13%, and for the 9 month period it dropped from $603.176 million to $578.845 million. This indicates cost control initiatives, or maybe the phasing out of certain acquisition related expense. As, which is a good sign for efficiency, this drop in expenses, combined with the rise in net interest income, is a major reason for the improved net income. And speaking of efficiency, the efficiency ratio, which measures how much it costs to generate $1 of revenue, improved nicely for the 3-month period. It went from 59.6% down to 56.5%, and for the 9-month period it improved from 61.7% to 56.8%. A lower efficiency ratio generally means the company is operating more leanly and effectively. Let's zoom into some specific numbers that really paint a picture of the company's loan portfolio in the real estate commercial mortgage section. We see the outstanding balance was about $9.734 billion near the end of September 2025. That is up slightly from $9.601 billion at the end of 2024. This is a pretty stable and large part of their business. The loan-to-value ratio, or LTV, which shows how much the loan is worth compared to the property's value, averaged around 63%, which seems pretty healthy. Now let's talk about non-accrual loans. These are loans where the borrowers are having trouble making payments or have stopped paying them entirely for non. Accrual loans, the total was $150.137 million as of the 30th of September 2025. This is a decrease from $189.293 million. At the end of 2024, this reduction is positive, suggesting better loan performance or successful resolution of problem loans non. Performing loans as a percentage of total net loans also improved, going from 0.92% at the end of 2024 down to 0.83% at the end of September 2025. This shows an improvement in asset quality. And what about the allowance for credit losses, the ACL? This is the money the bank has set aside for potential loan. Defaults, the ACL for loans stood at $376.258 million at the end of September 2025, which is very similar to the $379.156 million at the end of 2024. This amount as a percentage of total net loans is around 1.57%, which feels prudent given current economy. My conditions overall, Fulton Financial Corporation seems to be navigating the current economic landscape quite well. Their net income has improved significantly, driven by solid net interest income growth and, importantly, a reduction in non-interest expenses. The acquisition of Republic First Bank in 2024 appears to have been successfully integrated, contributing to scale and potentially some cost synergies. The company is managing its loan portfolio with a keen eye on asset quality, as evidenced by the reduction in non-accrual loans and the maintenance of a healthy allowance for credit losses. However, the decrease in borrowings compared to the end of 2024 might warrant a closer look to understand the strategic reasons behind it, and how they are funding their operations. The slight decrease in total assets as well could be a point of attention, but overall the company appears financially sound and focused on improving its operational efficiency. From my perspective, Fulton Financial Corporation is demonstrating resilience and strategic improvement. The focus on core banking revenue and expense management is paying off. The reduction in non-performing loans is a very positive sign, pointing towards effective risk management. The market seems to be responding well to this trend of improved profitability and operational efficiency. So what is the final verdict? Fulton Financial Corporation is showing strong performance this quarter, a testament to smart financial management and strategic decisions. The numbers suggest a company that is not only weathering economic challenges, but is actively strengthening its position in the market. Keep an eye on them as they continue to execute their strategy. Alright, that is our deep dive into Fulton Financial Corporation's latest quarterly report. What are your thoughts on their financial performance and the indicators we've discussed? Did anything in this report stand out to you? Let us know in the comments below. Your input helps us shape future content. And if you found this breakdown valuable, please hit that like button. It really helps us out, and subscribe if you haven't already for more breakdowns like this. And remember to join our growing community over on Discord. The link is in the description below for more conversations and insights on all things corporate finance. Thanks for watching Corporate Decoder. See you next time.